All right, thanks everybody for tuning in. I'm Mark. I'm the stock market jobber, and I've been getting a lot of questions about Tesla. Why is this thing in such a free fall? And of course, I don't 100% know, but I have some good guesses. I shouldn't even say guess. I have some good experience, which could draw me to the conclusion that I'm about to present. So I spent 2 decades in the institutional trading world, and believe it or not, it's probably not as sophisticated as you think it is. A lot of the clients of the hedge funds or the big funds tend to be pension plans, and the people who run the pension plans tend to not be very financially sophisticated. For an example, I was at a firm where we managed money for a Georgia fighters union. And we went down there and we met them, and they were great guys. But the person who ran the fund was a former firefighter. He wasn't a professional. So here's something that hedge funds do. And, I just say hedge funds because it's so hot and retail investors are so intrigued by it. But if you just go over to Market Lessons and read my little piece about what hedge funds are, you won't, they're not as mysterious as you think. The only thing that's different between a hedge fund and say mutual fund is the pay structure. But let's talk about this, okay? And this happens at the end of the year. We call it window dressing. Now, I'm not saying this is exactly what's going on, but there's a good chance that this has led to a big part of this move. So, what is window dressing? Well, every quarter, the clients of the funds, i.e., the pension plans or the endowments, they get statements that show their holdings. And managers don't want to have losing positions in their portfolio. Now, you might say, like, well, gee, Mark, that sounds so gosh darn simple that, aren't they more sophisticated than that? And my answer is, yeah, maybe some of them are, but a lot of them aren't. So window dressing is getting the garbage out of your portfolio. And I don't mean that Tesla's garbage. I just mean it's been down a lot. So if a fund needs to go to their client and be like, well, we haven't had a good year, and they start looking at their statement, they're going to say, well, why the hell is Tesla in my portfolio? Window. That doesn't look spelled right. Window. Well, this isn't a spelling class. It's a market class. But regardless, and I know you might think it's an oversimplification and it can't be that simple, but let me tell you something. I was in the institutional investment world for 2 decades. It's 20 years. And I can tell you that this happens. So companies or investment firms, they have stocks in their portfolio. They don't work out. At the end of the year, the Wall Street term is puke it out. Sorry for that, but it's, just puke it out, get rid of it. Because when the statement goes to their clients, they don't want the client to say, well, why do you have Tesla in our portfolio? Because the thing has been a loser. All right. So that's could be a big part of this. People are just dumping it out because they don't want their clients to question, why did you have this garbage in my portfolio? And it's not garbage. It's just a short-term thing. I don't know where Tesla's going to be in 3 years or 5 years. No one does. So a big part of this selling could be from what we call window dressing. The same thing happens on the upside too. I'm not going to include it right now, but take a look at Caterpillar. That's a stock that has done well this year. It's up significantly. And there's a buying frenzy. Just like there's a selling frenzy here, there's a buying frenzy in Caterpillar. So say that your portfolio, you were a hedge fund and you owned Tesla and you didn't own Caterpillar. Well, there's a motivation here at the end of the year to get rid of all your Tesla and throw some Caterpillar into the portfolio. So when you talk to your clients or when the clients talk to you, you can say, well, look, we got good stocks in our portfolio. We got Caterpillar. We got rid of the bad stocks. We don't have any Tesla. So this is what we call window dressing. It's like kind of changing your portfolio around. Is it unethical? Yes. Is it illegal? Probably. Does it happen? Yeah. Okay, so blah blah blah. Can we make money off of this? This is Tesla from a 3-year chart. Okay. Oops, let me get this stupid pen going. This is Tesla from a 3-year chart. Here, Tesla's been around for 10 years, believe it or not. Their stock is traded for 10 years. This was the most overbought that Tesla had ever been. Overbought means that it's trading at an extreme above what would be its usual or typical trading range. When these extremes are reached, traders come into the market because they're going to be expecting a reversion, and their selling could push the price lower. Now we have the opposite situation here. A year later, Tesla is the most oversold it's ever been in the history of the stock. It's trading at the most extreme below what would be its typical or historical trading range. And it's reached an important level. And at StockMarketJobber.com, we talk about how if something is oversold and reaches an important level, there's a good chance it bounces. So back here in 2020, this level around 108 was important. It was resistance. And remember, this is a 3-year chart, so remember, this is a couple months here. So we're extremely oversold. We've reached an important level. If a good part of this move is window dressing, which I suspect it is, when the year is over, which is only, frankly, a week from now, there's a good chance this thing rebounds. So that's our Tesla story. It's something called window dressing, and I just think that it's worth knowing about if you're a trader. So I'm not saying buy Tesla now, but I'm saying have it on your radar screen because there's a good chance that over the next week or so, this thing stages some kind of a sharp rebound. Remember, it's the most oversold it's been in its history, which is 10 or 11 years. All right, everyone. Thank you. I will talk to you soon.